Welcome to our latest cryptocurrency series webinar brought to you from the Digital Future Fund and the New Future Foundation. Today's topic is about a digital pound. What is all the fuss about and why the bother? And I'm delighted today to be joined by the fabulous, good-looking and great to hang around with, Mr. Jonny Fry. Hello, Jonny. How are you?
Good afternoon. Not sure about that nonsense, but there you go.
Big intro. You've got to live up to it now. I'll be telling you a little bit more about Jonny in a minute, but just to go through some of the intro stuff. Today's event is brought to you by the Digital Future Fund and the New Future Foundation. As I said, the Digital Future Fund is an exclusive investment, learning and networking community for qualifying individuals investing in high-tech alternative assets such as cryptocurrencies and other asset types in the high-growth, high-tech economy. If you're interested in joining, we not only have these public events, but we run private member events as well, in person and online. And those are more conversational, more learning events. And we'd be delighted to have you. You need to visit the website and inquire about membership. The New Future Foundation works with entrepreneurs, startups, and established business leaders to make the most of the vast potential offered in digital wealth creation by the platform economy. World Economic Forum stats state that 70% of the new value created in the 2020s will be delivered through platform business models. And our incubator and product innovation team work with technical founders and established businesses to conceive, build, and launch sector-specific platform businesses and products that are highly scalable. We specifically apply the platform business models where data, blockchain, automation, and AI are or will be having a massive transformative impact over the next decade. So just to be absolutely clear, this webinar contains no financial advice. We are not a regulated financial organization. Crypto assets are highly volatile and unregulated. And if you invest in them, you do run the risk of losing all your money. We're not giving any advice whatsoever. This is for informational and learning purposes more than anything else. And as I say, in order to facilitate this information and learning process, we're joined by Mr. Jonny Fry. Jonny is an esteemed member of the crypto and finance community. He's non-exec chairman for Gemini Capital, CEO and founder of Premier Asset Management. He's the CEO of Team Blockchain Limited and an author of Digital Bytes, which is produced by them, the content of which you do receive if you're a member of the Digital Future Fund, and you can also find some of it on the New Future Foundation website. As I say, he's a preeminent expert in fintech, finance, and crypto assets. So expert, in fact, that the reason for changing the event was that it was swapped over the reason that we're here today is that we had to move it from last month, where he was attending and giving advice to a government select committee on the technology and its impacts. Is that correct, Jonny?
Well, something like that. The only thing I was CEO of Premier Asset Management. It's a business I set up in the 80s. It's a London listed business, and I left that a few years ago to focus more on the very sector that we're going to be talking about this evening. So ex-CEO and founder of that public listed company, which still is around. It's got about 15 billion sterling under management. Fabulous.
Thank you, Jonny. So I'm going to just do some context setting for Jonny, and then he's going to kind of jump into talking about the subject, and then we're going to do a bit of a Q&A at the end. So I think a good question to start off by asking is crypto money? Well, crypto was originally pitched as an alternative kind of money, a form of money not controlled by governments. You know, it was in reaction to the 2008 financial crisis, and it was felt that communities other than governments and central banks and the financial services industry might be better placed to control our money and create our money than perhaps those centralized organizations. But to qualify as money, a crypto or any kind of digital currency has to do a certain number of jobs. It has to be a reliable store of value for individual participants. It has to be an accepted medium of exchange amongst the community. It has to be a functional unit of measurement to show the relative value of different assets and goods and services. And it also needs to be able to be used as a means of deferred payment through loans and finance and things like that. Now, crypto can do all of this. right? And there is a debate over how well it does some of it, and lots of cryptos and technologies in that space do different types of this better than others. You know, Bitcoin, for example, doesn't necessarily act very well as a means of transaction because the transactions take a long time to happen. But these technologies offer the potential to offer alternatives to traditional government-controlled currencies. And in fact, just in the last week, Mastercard has announced that they're partnered with 3 digital asset platforms in Asia to issue payment cards that will allow consumers in the region to convert Bitcoin and other cryptocurrencies into fiat currencies, essentially in real time in terms of the transaction. So they're joining hands with Hong Kong's crypto finance firm Amber Group, in Thailand with Bitcub, and Australia's trading platform CoinJar, and they're going to offer credit, debit, and prepaid cards. And they've already got agreements in place with Gemini Capital in the US and other organizations around the world. And this is in reaction to what Visa are already doing. So Visa has partnered with 50 platforms, including FTX, Coinbase, and Crypto.com, to allow you to essentially use your crypto to make payments. So yes, to all extents, you know, a crypto can be money. It can form or offer an alternative form of money to traditional currencies. It's all down to how good the tech is, and that is moving fast. You know, this ability to actually make consumer payments is a massive breakthrough, and the proliferation of that will really open up access to this type of financial asset. I think what is more pertinent question is crypto fiat money? So by fiat money, what I mean is dollars, pounds, euros, government-backed coins and finance. The question is, can it replace and do what the dollar does, what the pound does, what the euro does? And fiat is defined slightly different. It has to do 3 things. It needs to have the collective agreement of all the people that use it, that is the preeminent form of money that everyone is using. It needs to have trust, that it is going to be stable and reliable, and it's going to be around, and it's not just going to, you know, go up massively in the value or collapse in value. But it also needs to have a legal status. Okay, so it needs to be backed legally by the government of that particular region or country. And crypto, you know, really already meets 2 out of 3 of those. What it doesn't meet very well is the legal one, right? It hasn't been, not fully anyway, I'll talk about some exemptions, backed as a form of currency by governments up until now. And therefore, regardless of how good the tech is and how you can use it, it can't be defined as fiat money because it's not legally backed by a government or jurisdiction. But this is changing, right? So at G7 in Cornwall earlier in October, I believe, just last month, the G7 made a statement endorsing the principles of something called CBDCs, or Central Bank Digital Currencies, which is what Johnny's going to talk about. You know, they said that central banks would be able to launch CBDCs, and that they would complement cash and act as a liquid, safe settlement asset and an anchor for the payment system. They said the principles that they were putting in place were meant to support policy and design within the G7 and beyond for international banks and central banks around the world. To quote the statement directly, it said, we reaffirm that any CBDC should be grounded in our long-standing public commitments to transparency, the rule of law, and sound economic governance. Any CBDC must support and not do harm to the ability of central banks to fulfill their mandates for monetary and financial stability. Now, this level of coordination and communication with the G7, it says and does 3 key things. 1, it shows how real and immediate this subject of digital coins and cryptocurrencies and CBDCs is. It's something that, you know, G7 feels it needs to make a statement on. It also introduces the question as to how the big G7 economies are going to try and set and control the agenda when it comes to digital money creation and the digital currency situation. And finally, it shows how governments are now reacting to and racing in reaction to, you know, the 2.5 trillion plus crypto money markets that have been created to try and potentially have some say and control in where the digital money space goes in the future. And lots of different countries are doing different things. So Australia last month Jonny shared this on LinkedIn. The Select Committee on Australia as a Technology and Financial Centre said they recognise the significant opportunity and need to keep advancing the technology in this space. And they made 8 recommendations to their government: regulation of digital exchanges, appropriate regime for custody and deposits, a token classification exercise, commitment to a DAO, a decentralized autonomous organization structure, which I thought was a pretty cool commitment, very progressive. A review of anti-money laundering and counter-terrorism financing regulations, taxation breaks and taxation rules and opportunities around those mining, creating and looking after crypto if they do it in an environmentally friendly way. And for the Treasury to review and start planning for a retail CBDC in Australia. So a very progressive agenda in Australia, and a really clear plan. In the UK, you've probably seen headlines with Rishi Sunak talking about Rishi Sunak's Britcoin, the digital currency he's talking about introducing in the UK. The plans, you know, if introduced, would result in the biggest alterations to our money system in centuries, literally getting rid of physical money and replacing it with a digital alternative. And the Bank of England and the Her Majesty's Treasury have announced that, you know, after planning and researching this year, they will undertake a consultation in 2022, and this could lead to the launch of a CBDC in the UK or a Britcoin between 2025 and 2030. And indeed, just this week, the Digital Pound Foundation was launched. This group of companies, led by Barclays veteran Jeremy Wilson, said technology is transforming human interaction and money must adapt. The world has become a global laboratory for realizing the benefits of a new form of money, and the social ramifications of this will shift and affect everyone. And the digital pound seeks to support the UK in bringing about this change for the UK. And that includes companies like Accenture, Avalanche, which is a crypto company, Billion Group, CGI Group, Quant, and Ripple, which is an international crypto company for exchanges between international banks. So all of these companies are coming together to support that. In the US, Accenture is also involved in a similar digital dollar project, which is a not-for-profit project at this stage, really just to encourage research and discussion about CBDC in the US. And in the EU, Christine Lagarde, the European Central Bank president, has said the ECB should have a digital currency within 4 years. Beyond that, Nigeria launched eNaira on the 25th of October, and you know, within a few hours, 200,000 wallets were launched in terms of having a CBDC in place for Nigeria. El Salvador has been all over the news recently for actually committing to use Bitcoin and making it a fiat legal currency within their country. It's quite controversial, this, simply because, and seen as massively risky, simply because of the instability of the price of Bitcoin. But there's been several interesting stories come out of it, and Zimbabwe are looking at something themselves as well. There's even alternatives from the private sector looking to provide liquidity and currency services for third world countries. So Reserve Protocol is a project defined by 2 beliefs: that a stable currency should be a human right, and that hyperinflation can, and with time and persistence, can be eradicated. So motivated by this and a desire to make profit, which they openly say, they've built this project to help cope with hyperinflation and to control hyperinflation. And it's like a reserve coin, like a stable coin that can sit behind a currency. And they're working eventually to create a currency that is completely digital as well. Now, the project's still in the startup phase, but they already process about 15,000 transactions daily, which amounts to about 1.5 million US dollars in money moving today already, or per day. And that is already used by countries such as Argentina, Venezuela, Colombia, and in the US as well. So there's private enterprise activities going on in this space as well. So it's pretty clear that in the next few years, you know, the future of what happens with digital payments and digital coins will be decided. It is happening. The question is, and this is what we're going to explore a bit more tonight, is what are CBDs? How do they work? And who decides? You know, at an event this week, Credit Suisse said CBDCs will dominate the future of digital payments. You know, set up by governments and controlled by central banks. On the other hand, quote here from David Birch, who's a publisher and thought leader in this space. He said, it should be society that is setting the dials on what money they want, the new kinds of digital money, what should it do, and so on and so forth. We have the tools available to do it, and we should decide. And this is the big debate. Who gets to design and build the new types of money we use in the digital world, and who decides the rules? And this is going to define the next few years. Is a really exciting time, and will define money for centuries to come, potentially, from on that. So that's the challenge, that's the debate. And I think in order to be able to understand that, you need to really understand what CBDCs are and what's happening in the UK. And this is the point at which I'm going to hand over to Jonny, and he's going to enlighten you and tell you a little bit about that.
Blimey, James, you're worse than the missus. Okay, hello everyone, and nice to see a couple of people that already know. As James has kindly said, my name is Jonny Fry, a company CEO of a business called Team Blockchain. One thing I'd just like to get absolutely straight: I'm not an expert. I don't believe I've yet to meet an expert in this sector because it's still relatively new, and we're all actually learning. So please feel free to ask any questions. There is a chat button. Because actually we're still working out, if you like, some of the questions, let alone some of the answers in this sector. But as James says, it's really fascinating. In talking to some of the central banks, some of the clearing banks that we're dealing with, and on the public face, there are some of our clearing banks, our high street banks, who have written to their clients saying, if you accept money or if you send money into anything to do with crypto, we reserve the right to shut down your bank account. Behind the scenes, they have teams of 20, 30, 60 people in their digital assets division, working out, you know, not do they do it, but when do they do it, and what is their sort of first foray into this area. So we'll perhaps come on to that. But really what I want to touch, this is a very rough agenda of some of the things that we're going to look at and go through, but I'm very keen to make this interactive as possible, and any queries, any thoughts that you violently disagree with or agree with, then, you know, please do use the chat to come through. And unfortunately, it looks like we had a bit of a technical issue, so there's not a huge number here, so it'd be good. I don't know whether Charlie at some stage can put some of you on, sort of unmute you, and we can perhaps have a conversation even. But James, if you go to the next slide. So, you know, what we're looking at here really is, you know, sort of this whole sort of issue of cryptos and digital currencies. We tend to look at them, when we talk about digital assets, we tend to look at them as a universe. And as James has said, we write a weekly publication whereby it's then syndicated, and organizations such as James's company have a license to use the content. And because of the fact that, well, I'm personally regulated by the Central Bank of Ireland, they have asked to make sure that stuff that we produce is actually totally verified. So having come from a financial background myself, all the information that we actually produce and create is verified, and we use hyperlinks because that then gives people an immediate way to look into further details about what's going on. So there's a couple of sort of misnomers, I suppose, I need to sort of point out, and that is the crypto market is, yes, interesting, but it's pretty spivvy. 90% of the tokens, coins, shite that they actually produce, I'd just be really careful. These things can double and triple within a matter of a few days, and they can halve, if not more than a matter of a few hours. However, you know, what we need to do is understand the technology that is actually fueling them. And that actually, I think, has some really, really interesting use cases for the bigger market. And what I call the bigger market is the digitization of other assets. And those assets are things that are familiar to all of you because you hold them in your ISA or your pension, you know, things like equities, bonds, real estate. commodities, derivatives. And that's something which I think is a really interesting area. Stable coins, it's a complete misname. They shouldn't be called stable coins. They should be called pegged, because let's be honest, if you look at the value of the US dollar, the so-called mighty greenback, which is currently the world reserve currency, but soon not to be, and that's absolutely as it should be. If you look at the history of reserve currencies, they typically, they flower, they are in existence for around about 93 years. Prior to the dollar, obviously, we had pound sterling. Prior to that, pretty much because of the Napoleonic Wars, or Napoleon being beaten, because the Brits had a bit of hand from our sort of Prussian friends, it was the French franc. Prior to that, it was the Dutch guilder. Prior to that, it was the Portuguese escudo. Prior to that, it was actually the Spanish peso. So each one of those currencies have lasted on average about 90 years. The US dollar has been in existence, I think, about 94. So it would be quite normal to expect see the US dollar declining in value and something coming to replace it. But a lot of this topic of sort of digital currencies really got an injection from our friend Mr. Zuckerberg and creating something called Libra, which has now been renamed Diem. And basically he was proposing to create a digital currency. And I think really the central bank has got nervous because they looked at it and said, hang on, Facebook have got 2.8 billion people that log on and use their systems and proceed their sort of social media network and platform every single month. But 2.8 billion people is more than 3 times the entire population of the G7 economies. And if we suddenly saw people like my mother, who's 86, and she's got children and grandchildren all over the world. She used to go and get a postal order for Christmas and birthdays, and now it's sort of trying to send money, but it's a complete nightmare. She would definitely just click on and send a face coin or a Libra or Dinam, whatever they're going to call it. And then you think of the advertisers that power Facebook. If they would be able to given a choice of being able to use a different way of payment because it's cheaper, indeed, as we're about to see with Amazon, and we'll come on to that announcement, it's actually out today, then I think that that's something which is very, very likely to happen. And then finally, looking at central bank digital currencies, according to the Bank of International Settlement, over 80% of their members are looking to launch some form of central bank digital currency. Okay, next one, James. So very, very simplistically, I'm not a technologist. I've run and managed an asset management business for a number of years and been on a number of different companies. And it reminds me personally very much of the complete BS around is Betamax better than VHS? It really doesn't matter, because actually now people have got digital streaming. And if you just think of, if you like, blockchains, they're just a little bit like an Excel spreadsheet with better security built around them. And people shouldn't really get too hung up on the technology. It's more about how do you use that technology in business and society. And what's interesting is that if you had a choice and you were actually doing some form of illegal activity, would you do what most of them do, walk around with suitcases of cash and just run roughshod over all the banks, which is why the banks keep getting fined for KYC and AML, because they keep accepting suitcases of cash? Or would you have some sort of digital payment whereby there's a footprint and traceability? So there's been a lot of just nonsense by the sort of traditional people, by the naysayers, and by the press, unfortunately, who don't understand it, who are saying that, crypto is the preserve of the criminals. And certainly, I know a couple of you on this call, we were discussing this back in 2016 and 17, and it was really the cyberpunks, the people that wanted to get around the banking system, that were looking to sort of get on top of using cryptos as a form of transfer of value of money, if you like, because they were fed up with the banks and the costs and the hypocrisy of the whole structure. But now what we've seen is a complete upending, and we've now got corporations, we've got governments actually looking to use the technology of blockchain and creating these digital assets. And if there's one word that I would like you to try and remember this evening, and that's that one in capitals, trust. In my opinion, you know, I spend about 25 hours a week and have done so since 2018 in writing this thing called Digital Bytes, looking at how, where and why the technology and digital assets are being used. And the key word every time seems to come through: blockchains create greater transparency, and they create therefore greater trust. And that's really, really important in what was really a trustless environment, to be honest. And, you know, as the man Trump came out with, you know, fake news. Well, if you can actually have more trust in what you're hearing and seeing, then that's got to be a good thing. It's also really important when it comes to insurance, because greater trust means lower risk means potentially lower premiums from some new people. So here's just a couple of comments from people that, you know, I'm sure most of you actually heard of. And it's interesting to see, you know, some of these comments are now sort of 2 or 3 years old. And we've now seen more and more people beginning to realize the power of the actual technology behind a lot of these digital assets. I'll get mine to announce now.
There he is.
Okay, so James, I'm going back to our draft presentation, unless you can put your one up. Got to come off mute, James. It's like the bloody 2 Ronnies, this, isn't it? James, come off mute.
He's having connection issues, I think.
Okay, well, I'll keep going. So these, most of you I know are very familiar with, if you like, blockchain technology, and to be fair, know a lot more about the technology behind it, which is important when you're building a business using blockchain technology. But here are some of the sort of key points that we actually have sort of identified. And the reason I put in orange that little quote in the middle is that when you get statements like this from Deloitte, and where it says Luxembourg, you know, just put in there London, Singapore, Paris, Dublin, you know, New York, you know, and basically what it's able to do is to completely change the way in which businesses are run and organized, and indeed society. So as I mentioned before, I've come from a fund management background. And typically, you know, I would have said to you, well, why don't you buy our international fund? You know, it's top performing fund, annual management fee, say 1.5%. And then every 6 months, my company will have to write to you and say, I know I told you that the annual management fee is 1.5%, but the total costs of us managing your fund, well, it's actually 2.5%, because we have to pay the auditors and we have to pay the custodians, and we have to do this. And, you know, there's these layers of intermediaries which get in the way, and ultimately it means that the investors in the funds are actually paying for it. That's the bottom line. And whether that's in the fund management industry, whether it's in the charity sector, whether it's in the retail sector, you know, whether it's in banking, it's all of it. There are lots and lots of inefficiencies and layers of bureaucracy, because what we've tried to do is effectively shoehorn, if you like, an increasing digitized way of doing business and living our lives into an old paper-based box ticking type systems and procedures. And we haven't yet trusted that actually a machine can actually 100% check and verify, as opposed to relying on what's going on with, you know, with a, if you like, a computer, which basically does what you've programmed it to do until you tell it to stop doing it. So it's actually arguably much safer and a much better way to control risk. And this is something which is coming more and more to the fore with the regulators. Okay, so one of the reasons that blockchain technology is really important, because what it does, it actually puts data in a very structured format. And I'm sorry I'm talking about the technology behind, but I think it's really important. And looking at smart contracts, we've now had the High Chancellor here in the UK to actually recognise by law that smart contracts do indeed hold the force of law. And all you need to think of a smart contract is simply as a flow chart. If this happens, do that. So the example we've given here is AXA and an airline insurance. If your plane takes off by more than 60 minutes late, you will automatically be paid out on a 10 to 1, 20 to 1 bet. So you put a tenner and said, if my plane is late by more than 60 minutes, I will get, let's call it £100. And that money, it's not a matter of you then making a claim. That money, that claim, that bet, if you like, automatically pays off. And it's directed into your bank account as you're sitting somewhat frustrated, at an airport waiting for your plane to actually take off. So no human intervention. And we've got examples of this. We've seen the World Bank have actually done a bond. It's a catastrophe insurance bond for volcanoes. And they're basically saying, well, if depending on which way the wind blows, then the land that's in the shadow of where the wind's blowing, it will automatically pay out farmers for the ash fallout. And there's no point in having something on the sort of on the southern side of a volcano being paid when actually it's the northern side that gets implemented by a volcanic reaction. So we're beginning to see more and more of this. However, I've put in there the death of LIBOR, and I know I've got a few oldies like me, and they'll be very familiar with contracts using the London Interbank offered rate. This is a measurement of the amount of interest that you'd have to pay in the event of an incident. So, Tony, if I don't pay you the 100 million that I owe you, then I'm going to have to pay a penalty. I'm going to have to pay 2, 3, 4% over LIBOR. The trouble is that the good old city, they were all cheating and lying to a great extent. They manipulated that rate, and they realized they had to get away from a manually calculated interest rate. And now you've got something called Sonia, which is coming out. But if you'd have written a smart contract saying, oh, Johnny, you owe, Tony, 3% over LIBOR, well, and in 6 months' time, that contract's spinning around, LIBOR doesn't exist. So how do you now pay an interest rate on something that doesn't exist? So you need to be careful as to how you program and what you put within that smart contract. And you therefore need to be very, very careful of the oracles, where are you getting that information initially from? But what a digital pound enabled you, though, to is effectively to offer some sort of programmation of money, which is rather unique. As we all know, cash payments are actually declining. I'm sure many of you have been out and about. Some of you may have gone to Lord's this year. I don't mean to be blessed, but to watch cricket. And you'll actually see there, big signs, no cash accepted. And more, if you've got children or grandchildren, my son's 25 and he's walking around, and he was telling me the other day, he hasn't had a wallet now for 3 years. He carries no cash. He just actually walks around with one of these things and just pays for everything on his mobile phone. So we're seeing this happening more and more, which in some ways is a good thing, because actually handling money is really, really expensive for organizations. But meanwhile, we've seen obviously a huge increase in debit and credit card payments. So we're already seeing a decline of physical cash, an increase in electric money. And electric money, I'd argue, would be debit and credit card to an extent. So some of the advantages of digital money, and this is where we're beginning to see it, companies are beginning to realize that you can actually make payments, whether it's premiums or in the insurance world, you can have claims. You can have the use of this asset class, and this is where we come more back to the crypto. You've seen companies, very large asset managers, who are now saying, well, actually, we think that it's a good idea for us to diversify our investments. MicroStrategy arguably is a bit of an extreme, because they really are sort of come almost evangelical about this, but they're now holding the majority, and they've actually gone out and raised more funds to go and buy and hold Bitcoin. And to be fair, it's been a fantastic strategy for them, and they've substantially increased the value of their business because they've taken that as a stance. But there's more and more companies here in the UK, also New York, that are offering treasury management services to enable companies to be able to have a diversification and hold 5 or 10% of their cash that would normally be on account in some of these different cryptocurrencies like Bitcoin. But the one thing that people seem to focus on when we're talking about digital money is, oh, well, it's going to be great because it's going to be reducing sort of banking fees. And yes, of course, you've got remittances, people sending money back to their family and loved ones. So these are typically the poorest paid members of our society. It's your janitor, it's your shelf stacker, it's your security guard. And not only do they have to work typically nights and in pretty grotty conditions without many other benefits, we then charge them up to 15% to send their, $100 or £100 or 100 yen back to their loved ones because we can, quite frankly. And the banks have been doing this for years and years. And the remittance market is something in excess of 600 billion a year. So potentially there's about 90 billion worth of fees that these guys are being charged. Whereas in a digital environment, it falls to fractions of percentages for payments. And the other thing I think worth bearing in mind, if you look at the World Bank figures, there's 1.7 billion people in the world that are not part of the banking system. And they're outside, they're excluded from finance in effect. But according to the World Bank, of that 1.7 billion people, 2/3 of them have access to a mobile phone, which means that if they've got access to a mobile phone, if they've got access to a digital currency, they can move money globally. They can buy insurance for their crops. They can get better prices for their goods. They can actually have much greater access to sort of lending and borrowing, especially as we start to see more and more DeFi platforms coming on. So they then can actually, do better themselves and strip out all the wiring agencies and strip out all the money lenders and actually, take out those intermediaries, which, take away so much of the actual cash ultimately for themselves. One of the other things we're beginning to see is the ability, and this is where we're seeing regulators beginning to realize that the technology and digital money gives them some real benefits. So at the moment we have this crazy situation, and I take BP because it's in theory it was a petrol company, or petroleum company. Now it's saying beyond petroleum, and they're desperately trying to sort of be a nice, clean and friendly, ESG compliant business. But nevertheless, if you held BP shares for effectively 5 months and 30 days, then typically, and I come along on the 31st day and actually hold the shares, and then they go ex-div, I get all the income. You've just had best part of 6 months worth of risk of those shares going up and down, but I get 100% of the income because they went ex-div on that day. And in conversations, certainly here in the UK, the FCA, they're saying, well, is that treating customers fairly? And that's really important because the FCA are established to not only preserve the integrity and confidence in the financial system, but also to ensure customers are treated fairly. Whereas if there was an alternative way, say, we now have digital shares. So again, putting this digital wrap around an existing equity, nothing to do with crypto. And therefore we can then start paying out dividends on shares, or we can pay coupons on bonds or rental income on property. And we can actually pay that based on the number of days, or certainly the number of weeks that you've had exposure to that asset, and therefore what proportion should you be entitled to. And notwithstanding that, we can also tell you, here we are at the moment, it's around about 10 to 6, on Wednesday, the 17th. And you do not know currently who owns BP shares. Within a couple of hours, when the share registrars are sort of netted off all the ins and outs, they'll be able to tell you. And that's not great for the regulator. So if you had a digitized BP class of shares, then you'd be able to tell in real time who actually owns those shares and where they actually are at any one time. So what we're now seeing is, the question was, well, why bother? And talking to James about, well, why do people need to worry about this digital pound? And I think there's a couple of areas. We've talked about remittance. I think another huge area is going to be loyalty cards. If you look at the French supermarket, they have a stable coin backed 100% by euros held by Societe Generale. And they're using that as part of a reward mechanism. So it's a bit like Tesco Club Card points, or a bit like Air Miles and that sort of thing. And what was interesting is that in the first 10 weeks of launching this, they had about 7 million euros in there, and it had already turned over 100 million of actual euros. So lots and lots of transactions going through. But what we're seeing is the challenger banks and their valuations are really meeting or exceeding some of the longer standing high street banks. And for those of you that haven't seen it, we had an article that today written by Clearbank. Now Clearbank, for some of you may not be familiar, is the first bank in 250 years to be granted clearing bank status. And they were set up and encouraged to be set up by the Bank of England and by PRA in order to be able to facilitate these banking apps. So to be honest with you, Revolut is not a bank. It's basically a payment platform. and yet it's valued at 30 billion sterling. So behind a lot of these, the Starlings, the Tides, these sort of companies, they need to have someone that can interact with the banking payment rails, and that's a role that Clearbank actually carry out. And they've basically said in their article that the gatekeepers, the banks, are going to have to embrace this new fintech challenger companies because they're actually able to provide digital services, and because it's digital services, they're going to need digital payment methodologies. So interesting to see, one of the banks actually admitting that this is something very much that they see coming through and happening. But why? And this chart, you can see, the amount of time it takes to make a payment. And people are saying, well, it's just not acceptable. I could well have lost reception, a bit like James dropping out a minute ago for a couple of minutes. Well, if I've lost reception, has my money gone through? Hasn't it gone through? And the challenge of fintech businesses have got their systems so that they are faster and more efficient and be able to give people the customer services they actually really want. So that's a sort of formal part of the presentation. One thing that I did want to touch on, because it's something which we have discussed, I know, James, in the past, and that's this whole thing of what can we learn from history? And I'd just like to sort of leave you with this thought. I've already mentioned about the decline in the US dollar and why it's absolutely inevitable, and we need to embrace it rather than pretend it won't happen. But what we're seeing is effectively, I think we're going to go back, not to quite the same extreme, but if you wind the clock back to 1862 in America, and I know some of you are almost old enough to remember those days, you had 7,000 different types of US dollars, 7,000, of which 5,500 were fraud, were just made up, completely made up. So because of that, they established the National Currency Act in 1863 in America. And that effectively led to the creation of the US dollar. And for those that are interested, the symbol of the US dollar effectively is based on the Mexican peso. And that's where they get the sign of US dollar. In the UK, a similar sort of situation whereby we saw banks could just issue, any bank could issue currencies, and along came the Bank of England, which had been in existence for by that stage for around about 200 years. And they said, no, we're going to restrict the number of banks. And it was banks, it was Bank of Scotland and a couple of banks in Ireland that were able to issue their own currency, but it had to be backed by gold deposits with the Bank of England. So I think that what we're going to see is the creation of a number of central bank digital currencies. They will not replace cash. They will run alongside cash, and they will probably act at a effectively, they will act as at a wholesale level. And then alongside that, we'll then see central bank digital currencies encouraging the actual sterling and dollar and euro stable coins. So these will actually be backed by fiat deposits. And arguably, they're much, much safer than having your money in the bank. Because if you have your money with Lloyds, NatWest, et al., then you're reliant on fractional banking. You're reliant on them actually having the cash. Because I can guarantee if any of you tomorrow go into any of your bank accounts and say, I'd like to withdraw in excess of certainly £5,000, they'll ask you to come back tomorrow or probably next week. They don't have the cash because they've lent the money out through fractional banking. Fractional banking's only been around for 50 years, but if you actually have your money in a sterling-backed stable coin, provided the actual mandate of that stable coin is 100% backed by cash, then your money is going to be a lot safer than leaving your money in the bank. And don't tell me banks don't fail, because we've seen, banks do indeed fail. But I think that's one of the reasons why I'd argue a stable coin is much, much safer. And the second thing is that there's absolutely no way you're going to see a sterling central bank digital currency whereby individuals can have unlimited access to that unit of account. Because if they did, we'd be mad to leave our money in the clearing banks. We would put it all into a currency backed by the Bank of England. And that would create a massive run on the high street banks, because effectively liquidity in the credit market would evaporate overnight and the clearing banks would just fold over. James, you're looking even more confused than normal.
Technology has really tried to get the better of us today, hasn't it? It's a shame. It's a real shame because the content is just brilliant and fascinating, and I'm learning a lot of stuff here as well. And I think it's really interesting. I think, I think a question I'd ask for me is, well, I think, you mentioned these figures of 1863 of 5,400 fraudulent versions of the dollar, 7,000 versions of the dollar, and the bank came along and said just one. Those numbers, they ring bells, right? When you're looking at how many types of cryptocurrencies and assets are out there kicking around at the moment. Do you foresee a situation where they literally come along and say, that's it, no Bitcoin, no anything like that, you've got to use the CBDC, or do you think there's a world in which both can exist side by side?
I think both will exist side by side. I think that the majority of the crypto crap, as I refer them to, will just naturally die out. I see a lot of what's going on in the crypto market very, very similar to smaller company stocks. And if you go back to the 80s, people referred to buying shares on the big board. And one of our attendees, Anthony's from Canada, he'll know the big board referred to the mining stocks in Canada. And then you talked about buying stocks in Wall Street on the pink pages. And I see, and people realize that buying and selling penny shares, small companies, was highly volatile, but also very, very profitable. But even the institutions stopped buying them and gave the money they wanted to allocate to smaller companies to specialist asset managers, because there's no liquidity that we can deal with. There's huge amount of research. We'll pay, we M&G, we the Pru, we, Lloyd's, we will pay specialists to manage smaller company, typically investment trusts, because then you've got a protection in terms of liquidity can't be taken in and out. So it's a slightly different, it's a closed-end vehicle as opposed to an open-end vehicle. And I think that's what we're going to see here in the main markets. And I would point some of you to have a look at a company called KASEI, KASEI, and it's on the Aquis exchange. So it's under the ticker AQSEKASH, cash or cash, if you like. And what that is a closed investment company set up by a bunch of clever guys who are ex-derivative traders and equity traders. They've put their own family and friends' money, tiny, it's only 5 million. But once the money's in there, you can't take it out. And they're now going to, you can sell your shares in the company, but they haven't got to worry about, oh my goodness, I've suddenly got a whole lot of money in, I've got money out. And they're going to invest the money in this particular case into cryptocurrencies. And it's exactly the same formula as something called Foreign and Colonial Investment Trust, which was set up in the 1870s to actually finance American railroads. There was no liquidity. I want to invest in some place called New York that's got lots of hungry people, and there's some place called Chicago got lots of beef. And if I can get a railroad between the two, I can make a huge amount. And seriously, that's how it was. But there was no liquidity. You couldn't suddenly sell a bit of rail track. So they had to set up a closed company, and then they were making profits off of, obviously in that case, the freight rates as they're going wrong. So that's that's a FTSE company, the F&C Investment Trust. So it's a similar sort of thing with this company, and I think we're going to see lots of that. And that's a much safer way than trying to have a bet and say, well, am I going to get the next Dogecoin or Cebu but you see, look at Cebu, or Shibu, or bloody thing, whatever it's called. It's gone up 84 million % in 1 year. So £3,500 is now worth 1.5 billion. Yeah. But during the year, that token, that coin, that bet has at different stages fallen by up to 81% in value. But if you just risen it out, recently it's had a big pullback. But my point is that a lot of the crypto is gambling. What we're talking about here, when we talk about central bank digital currencies, or we're talking about stable coins backed by fiat currencies, there are poles apart from cryptocurrencies, but they are part of the infrastructure that that society needs, that banks need, that asset managers need to be able to pay dividends on a regular basis, to be able to send money more cheaply, to be able to encourage children to pick up litter and recycle it and pay them on their mobile phone as to paying them in cash because dad comes home and nicks it.
So you could very easily see a world where you've got a CBDC and plugging into it, you've got lots of different kind of financial services that are built on blockchain technology, essentially, is what you're
but not using the CBDCs necessarily. That's why you can have to stablecoin. So just before we came on air, I mentioned to you that Amazon have just announced that they are no longer going to accept Visa as of January. Well, if you go back to July, I think it was this year, you'll see that Amazon were advertising head of cryptocurrency. And some of you might want to Google Amazon head of crypto, and you'll see the job application on the Amazon site has been removed because they've actually found someone. So my belief is what you're going to see within the next 18 months, Amazon will come out with some sort of Amazon coin. I know it's not a lot, but it's, 0.2, 0.3%. That's what Visa take. That's what Visa are earning. Now, Mastercard have said, we're going to give access to our 20,000 financial institutions and our millions of merchants the ability to be able to use digital assets, central bank digital currencies, stable coins, cryptocurrencies. You can use that on the Mastercard platform. So I think that what you're going to see is an Amazon coin coming out linked onto potentially either Square, PayPal, or the Visa network infrastructure, rails as some people refer it to, and they'll be able to take out that. They'll share. Maybe they make an extra 0.1 on every transaction and say, sorry, Visa, we're not going to use you anymore. And Amazon have the ability to do that.
And when you think of the money and capital Amazon control, but also the number of customers engaging with them as well, the size of that as a finance is going to be really interesting to see. You mentioned how, had the reaction to Libra, which were from Facebook, which really seemed to stall. I can see governments really being very nervous about this area, and the amount of weight that these organizations.
But James, go back to Standard Oil in the 20s and 30s. And Standard Oil was, the most powerful institution, in the world. And it basically had enough cash to finance itself, didn't need the banks. And it was so powerful, it got broken up into the Seven Sisters, and the biggest one that still remains is ExxonMobil. And you could easily see that potentially happening to Amazon. But actually, if the US government say, Amazon, we're going to break you up, what's to stop Amazon saying, bye-bye, we're off. We're off to a digital friendly environment, wherever that could be, the Isle of Wight.
There is, there's quite a big lobby, isn't there, in the Republican Party for breaking up all the big digital giants at the moment. So it is that early 20th century repeating itself to some extent in that respect. And I think that ability to look back and, some of the stories you've come up with telling us here about what happened 100, 150 years ago, those are ones I've not heard. And it really helps put it in some perspective. I've got a couple of other questions, but I just want to encourage those of you on the call to, if you do have questions, either drop them in. Maybe Charlie, you can let people actually open up and speak a bit, as well, as we've only got a handful of numbers. I've actually got more requests to send the video than I do than there are people who made it on the call already. So we'll be following up with that nonetheless.
What I'll ask people to do then is, if you put your hands up if you have a question, then I can allow you to actually come through and talk.
So one thing, whilst we're waiting for that then, Jonny, I'll ask you is, we talked about things like Amazon having their own coin and things like that. What about thinking about other types of financial assets, such as, for example, smart assets and smart contracts that could be, for example, wrappers for company shares or other different forms of assets and things like that? Can you see a world in which that is linked into, some kind of government stable coin or CBDC or something like that, where there's, that immediacy of transaction between assets and fiat currency, for example? Yeah,
well, I think I think there is a, we've looked hard at this. What could replace the US dollar? And potentially, what if you could wave your magic wand and you could digitize a variety of assets? So you digitize commodities like gold, silver, palladium, etc. Digitize real estate, digitize fiat currencies, which is relatively easy, digitize equities and bonds. So let's just sort of fast forward to, say, 5 years time, and you had the ability to be able to get digital exposure to these digital assets, which are traded 24 hours a day, 7 days a week. And then you create a unit of account whereby it has some exposure to the US dollar by dint of owning US dollar assets, i.e. real estate, equities, bonds. The same for, Europe, the same for Asian markets. And they actually have a basket which is weighted on the, if you like, the economic value or the total market capitalization of those different assets. And you wouldn't necessarily need to hold very much in underlying fiat that you would indirectly be exposed to the US dollar or the pound or the Singapore dollar or whatever because of the asset. And it would effectively be backed by real assets. It wouldn't be backed by, you know, the lunacy that we've seen in terms of just printing cash willy-nilly. And that's what we've got at the moment. We've got, you know, we've got massive inflation, which people don't want to talk about. I was talking to a Chinese client of mine on Monday, and he was telling me that he reckons inflation in China is running at somewhere around about 25%. That's what he's talking about. If you look at the IMF figures, and we put a LinkedIn notice out yesterday, and we're looking at food prices in Latin America, and it always occurs in the, and I hate, I'm not politically correct, unfortunately, but they used to be called emerging markets, but they're developing markets, you know, Latin America markets. They're very, very sensitive to inflation. And if you look at food prices inflation in Latin America, you know, again, it's running in double digits. And yet we're walking and saying, no, we've only got 4% inflation in the UK and 6% in America. Come on, just wake up and smell the coffee. You know, you go out for a coffee, you know, go out for a meal and see the cost. Okay, I know we've had the problems with, you know, with energy prices, and to some extent that is a temporary aberration, but that was exactly what happened in the 70s. You know, it was petroleum prices that zoomed up, which then kickstarted. Everyone said, well, if this does stay the case, then we're going to see. So you're going to see, now historically, if inflation takes off, there are two asset classes that you really want to be exposed to. One is gold, because historically, for some mad reason, because it's quite difficult to manufacture or dig up too much gold, you want to hold things like gold and silver and some of the other precious metals, or real estate, property. And, you know, what a surprise, if you look what's happened to property prices, that they're actually going up very, very well. The problem with property is it's highly liquid, in the sense that, you know, you can't go and put £10,000 into a house, but there are companies that are working on it. And that's exactly what you'll be able to do. You'll effectively be able to have fractional ownership of a real estate, of a house. And I don't mean buying tokens. I mean, your name will be on the land registry. So I could buy 1% of your house. Your house is worth £1 million. I give you £10,000. And when you come to sell a house, you know, let's say you have a mortgage of 10%, you know, Barclays get paid off their mortgage. I get paid 1%, and you get the remaining 69%.
I know Anthony on the calls involved in a fractional property based thing as well. And I'm aware of a project called Twindig that I'm quite involved with that's doing something very similar. So it's certainly something that's happening. I've seen fractionalization of all kinds of illiquid assets. I met a company in London last week who are offering fractional parts of class actions against big organizations to fund big class actions, you know, because they're notoriously difficult to fund and there's lots of people involved in them. So they're almost perfect for that kind of ability. There's a couple
just a note of caution. I was at an event actually with Anthony Abel, who's on the call from TPX, this property business that effectively going to be offering fractionalization on a regulated exchange. And at this event, it was like a deja vu. 5 years ago, every man and his dog was coming up and talking about, I want to do an NFT. I want to launch an NFT. And you say, why? Well, because this is a true story. I had a very, very clever scientist, doctor, whatever his name is, came and was really giving me a hard time about, I've got some really great ideas to invest in stem cell research. And I was saying, well, that's great. You know, fantastic. Why do you want to talk to me? Well, because I want to launch an NFT on this. And I'm going, and I said, what, on your hair? I said, you know, Grecian 2000. He said, no, not my hair, my brain. And I said, well, what do you mean? So I want to tell people, I just need $1 million. If you give me $1 million, I'll put it in my wallet and I'll give you an NFT of my ideas. It just struck me of ICOs in 2016. Utter effing nonsense.
Yeah, well,
I really be careful, because this is going to end badly.
I've seen projects out there that, you know, I saw a project of Stephen Stanbury on the call shared it, and it looked really interesting. It was built on Solana, but it was basically combining Farmville. You remember the Facebook game Farmville, where you go with DeFi. So, you know, literally you grow a little farm and it lets you lend money out to people, which I thought is a crazy way to treat debt and lending to people. But these are the kind of projects that are popping up at the moment, and they're interesting, they're exciting, they're different. But as you say, it's a wild, wild world out there.
But some of those iterations will lead to some really interesting projects.
Yeah, absolutely.
And amazingly, you've got now DeFi exchanges, which are some like small markets. It's regulated by BaFin, so it enables institutions to start going on and doing yield farming. And offering insurance and getting involved in a regulated exchange, and that will lead to other innovations that will come through.
I'm going to open up some questions from the floor. We've got Martin's got his hand up. Martin, good to hear you. Thanks for sticking around. Maybe you'd like to ask your question.
Yeah, well, thank you, James. Thank you, Jonny. That was brilliant. And you say you're not an expert. I think way too modest, but I get your point on this being an evolving world. But a couple of things. The National Currency Act, that really shows my poor history, but the 7,000 forms of dollar, because I've been saying something similar in my view on the cryptocurrency exchanges, which I've been following closely because I'm a director of a proprietary trading business and we've got a crypto desk. And my view is that is all, so many of those is just going to all end terribly for the exchanges, the unregulated exchanges. So one, I was interested in a quick view on how many those exchanges might become regulated if you have one. But also it's the veracity of the data that's coming out of these, which I'm really questioning, and people seem to be relying on, and they're alleging there is institutional money already in them. So I get emails from, I think it's called Global Block, a listed brokerage, crypto brokerage in Canada. And this morning it's saying, what's the email now? But it's proclaiming in absolutely unequivocal terms that the whole crypto market is worth 253 trillion. That's just that. I'm just scratching my head about the veracity, how you verify that, and how the hell any institutions are near the cryptocurrency exchanges. The blockchain stuff, totally agree, love, not that my views came. So anyway, so it's long-winded, sort of two questions, but I was very interested you did touch on the exchanges.
Okay, so first of all, majority of the exchanges aren't exchanges, they're platforms.
Exactly, yeah.
And there's huge issues around custody. And commingling of funds, and I think what we're going to see is we will see regulated exchanges. We are going to see them. So you got our checks in London, for example. You've got SIX, which is in Switzerland, and as we start seeing regulated exchanges are really, really important, because if a regulated exchange manages to reach recognized status, it means then institutions can buy assets that are quoted on a recognized exchange. So it means that you can actually then, for a pension fund or for a mutual fund, you can buy assets listed on a recognized stock exchange. So the average punter doesn't care, but that's really, really important for the asset managers, which ultimately are the people that control the money, and will bring the liquidity. In terms of your point there about liquidity, we would just had a bit of fun the other day. It was brought to our attention that the Chancellor Exchequer is going to pick up £1.5 billion sterling windfall because of people have been staying at home and they're turning into day traders. And day traders is easy. It's like sailing a boat. Sailing a boat into a harbour when at high tide is dead easy. It's a son of a bitch if you're trying to go across the sandbar into the harbour and at low tide, because you get exposed. And we haven't had a bear market now in realistically 12 years, and it's about to come. Absolutely guaranteed you're going to get a decent shakeout in the equity markets, and that will flow through to some extent into the crypto market. And liquidity, because they are effectively smaller companies, as I've already mentioned, the liquidity will dry out. And if you look at the liquidity in some of these cryptocurrencies, there's just nothing there, and it's just completely dried up. And a recent example of that would be what we saw with the complete scam with Squid Coin. Some of you may be familiar with Squid Games. Which is taking Netflix by storm, and the thing went up by tens of thousands of percent until someone half decent in terms of volume then started saying, I want to sell, and of course there was no liquidity. Having said that, there is some really interesting and some very deep pools of liquidity in certainly I'd say the top 10, maybe top 20 of the cryptocurrencies, compared to comparative companies that are quoted, and that's because it's global, it doesn't respect boundaries. And it does trade 24/7. So you are going to see companies like Nestle coming out with digital equivalents of their shares listed on digital exchanges. And I think once you start seeing that, that's going to make it very interesting. And I'd look at the announcement. It's been lost, I think, by many. Two now, one a little while ago, and that was looking at PIMCO, who are one of the biggest fixed interest fund managers in the world, and saying basically we want to start buying digital debt. And the second announcement, much smaller company, a company called Crypto Compare, which if you're in this sort of kind of weird market that we find ourselves in, you'll have heard of them. And Crypto Compare were given a license by the FCA to start creating indices. So they're going to be able to create the equivalent of the S&P 500, the FTSE 100. And that's interesting because it now means you've got benchmarks, indices, which allow the asset managers to come in and say, we're going to come out with an ETF, or we're going to come out with a mutual fund that tracks the Crypto Compare 100, let's just say. Good for Crypto Compare, because bear in mind, if you want to have a fund that tracks the FTSE 100, FTSE will charge you £50,000 a year just to use their name. So Crypto Compare could have stumbled across something quite neat, whereby they're just going to be paid huge license fees just to use their stuff. But more importantly, the FCA recognise we need to have a better oracle, if I can use that expression. People need to be able to say, well, I'm going to track the top 20, 30, 50 currencies, and this is a company that we think maybe has the systems and procedures to be able to have something to do that.
Martin, thanks for the question. That's a great answer as well.
Thank you very much.
Just on that note as well, I guess something maybe just to think about is, how I can understand how most exchanges are centralized, right? So they fall within a particular jurisdiction. That's what governments and regulators really want. But in terms of the decentralized exchanges, that to some extent they're a little bit beyond regulation and control, right? Certainly that's the principle on which. So what's your view on decentralized exchanges and their role and impact? I mean, do you think they can survive? Do you think outside of the system? I mean,
if DeFi has a lot in common with eBay, and I don't know, you see all these, seeing advertising on TV, in terms of, I want to sell my secondhand, wardrobes and shoes and clothes, and no one's getting involved in, what people don't realize in the UK, money is not regulated. I can manage your cash and I don't need to be regulated. So I can move your cash between, sterling, dollars, euro, yen, Swiss franc, and I don't need to be regulated. So not very few assets, houses, cars, they're not regulated assets. And you may well, and you've got a real mixed message. We've already touched a little bit on NFTs, non-fungible tokens. In theory, cryptocurrencies are banned in China, but non-fungible tokens are being encouraged by the Chinese state. You've got do you honestly think that the Italian government are going to start suing the Uffizi Gallery because they've been selling NFTs on Michelangelo paintings, and ditto in St. Petersburg? No, they see it as a form of revenue. They say, well, that's okay. We're not too, and whether you're going to see platforms, exchanges, the only role they carry out as some to self-sovereign identity, to actually be able to say, we know who this person is. You don't need to know it's Jonny Fry, but you do need to know that he's got money and we're comfortable. Actually, we know where he lives and we know what he does, and you can do it. He's on a white list. It wouldn't take that long to create these white lists and do away with this ridiculous KYC and AML, which doesn't work in a paper-based format. And that's the big thing the governments are worried about. But this is also why the governments will bring out central bank digital currencies, because the shadow economy, in the old days, we'd call it the black economy. That's probably not politically correct to say that. So the shadow economy, the informal economy, the illicit economy is around about 15% of the world economy. Now, in the US, it's running around about 12%. Over here, it's about 10% in the UK. But you've got some countries like Zimbabwe that you mentioned earlier on, it's over 70%. You've got somewhere like the Philippines. The Philippines, something like 71% of its population do not have a bank account. And yet 40% of all the people playing Axie Infinity, this online game, which has already sold $2 billion worth of NFTs, 40% of them, the game was invented in Vietnam, 40% are in Vietnam, in the Philippines. And the Philippine government is now saying, we want to regulate, we want our share of the tax, because people are earning, $40, $50, $100 a day by playing this game. And I know that doesn't sound very much, but when you look at the annual average income in the Philippines is $3,500 a year, and people are earning, you know, maybe $50 a day, you can start seeing why the tax man wants to get their take. So if you look at the average turnover of all of the cryptocurrencies, and go on to CoinMarketCap, CoinGecko, and if you look at the average turnover, it's about 340 billion a day, and then multiply that by 365, and then put on a transaction charge. In the UK, we'd call it stamp duty. That generates $600 billion every single year. So all this COP26, COP27, COP69 eventually, why don't we just solve that problem, stop arguing, and say, there you go, we'll give you half that money, 300 billion, and they're every single year to sort out some of the challenges around climate change. I want to start being a bit more creative about this and stop actually, you know, effectively deluding ourselves and saying, oh, well, no, you know, 90% of people are trying to do something iffy and dodgy with money. No, that's just not the case. And it's the banks who keep paying the money laundering fines because they're not doing the job properly.
So if they can tax it, they can allow it, and you need more creativity in the space at the end of the day.
And what happened with alcohol with prohibition? What's happened with CBDC? Not CBDCs, that's the currencies, the other stuff, the CB. You know, the not heroin. You know what I mean?
CBD.
The hash.
CBD.
CBD, thank you.
Yeah, CBD.
And now they're charging tax on it. And it's slowly sweeping across many different jurisdictions.
Jonny, we're running long, and that's because the content's brilliant and everyone's really enjoying it. And I talked a bit at the beginning. I've got one last question I'm going to take from Stephen Stansbury, and then we're going to say thank you and good night to everyone. Stephen asks, when do you think crypto will decouple from the stock market, if at all?
What do you mean by decouple? Do you mean,
Stephen, do you want to jump on and answer that?
Do you mean in terms of correlation?
Yeah, I hope my audio is okay. Sorry.
Yeah.
It's just at the moment I kind of noticing that, you know, if when people when they're into stocks, they tend to be into crypto. We're seeing a lot of kind of price movement that's reflecting that in the stock market, whether it be the Dow Jones and the FTSE. And I just want to know, I'm a great believer in the long-term kind of the ability of, you know, cryptocurrency. It's anti-inflation and it's really great for the environment. But I'm kind of wondering, when is that going to happen? When are people going to stop kind of buying? When's the bubble going to pop? And when are people going to start kind of pumping their money into crypto instead of using stocks as their main investment? Yeah, that's kind of it. Just trying to find out when they're going to happen.
Okay, so clearly no one knows the answer. That's the bottom line. This is what comes back to, you know, I'm not an expert, and anyone that says they've got the answer to that question, unfortunately, I would take with a massive bucket of salt. But what you might want to look at the number of mutual funds compared to the number of traded equities in places, you know, such as, you know, UK, most of the European markets, and certainly in America. There are more funds than there are quoted stocks. And that's because, you know, it's been proven time and time again that a monkey throwing a dart at the copy of the Wall Street Journal has got much a chance of picking a winner as your average fund manager. Here says a fund manager did it for 30 years. And that's why we've seen the massive increase in exchange traded funds, which effectively were sort of index type funds. Very, very low cost, but they will track the FTSE, the S&P 500, the CAC 40, the DAC, whatever it may well be, the Nikkei 225. And therefore, you want exposure to equities, go and buy an index fund. And therefore, what we're actually seeing is once we've got the ability to buy funds, and that's why it's not a fund, but I suggest you have a look at this company, Kasai, because that's a little example of you can put your money in. Now, who knows whether the fund managers themselves will actually pick the right ones, but at least they're going to give you a spread of 30 or 40 different cryptocurrencies as you're trying to pick the next Dogecoin or missing out on the next sort of, you know, Shibu, for example. So when it becomes easier, and this is why regulation is so important. So I've talked a little bit about some of the regulated exchanges, and it's actually not really down to the individuals. Individuals don't really drive the stock market. It's the institutions that drive the stock market, and it'll be institutional engagement that will drive the crypto market. But I fear that fundamentally most of what's behind crypto doesn't stand up for examination. and going back, you know, and looking at, you know, what's really behind some of these cryptocurrencies. You know, it's very, very difficult, if not impossible, to find out what really does back them, and therefore, you know, would you want to put serious money into them? In terms of the decoupling from a correlation point of view, again, just go back and look at the recent stock market corrections that we've had in 2007. Then you'd really, I suppose, got to look back at the two Gulf War invasions, and those of you sort of, you know, really ancient, look at 1987 with the stock market crash. Now, these are all happened in the last 40 years. And then what you had a period of a couple of years once the equity markets took a tumble, where people were looking at alternative investments. And I think at that stage, people will then start looking at alternative investments, and they'll be looking at things like yield farming because they want a high yield. But unfortunately, there's so much froth and so much belief that Tesla is going to go zooming back up, even though it's had a bit of a correction, or any of the other FANGs. But just look at the PE ratios on some of the world's biggest companies. And it's, you know, you talk about, you know, PayPal, I think it's on a PE of 64. Well, I know PayPal's done well, but, you know, should PayPal be worth almost the same as, you know, JP Morgan, the biggest bank in the world outside of the Chinese banks? And we could see equity markets take a very, very, well, you know, I'm predicting a 20-25% fall in equity markets. And that's because interest rates are going to have to rise. And most of these companies got so much debt because they've been leveraging their balance sheets to buy back equities, because earnings per share, a lot of the directors in the UK and America, and not so much in Europe, they get paid their bonuses based on, can you grow the earnings per share? Well, if you grow the profits and leave the number of shares the same, your earnings per share are going to increase. But if your profits stay the same, well, the only way to get the earnings per share up is to actually cut the number of shares, and your earnings per share goes up. So you've got less shares to share the earnings around, if that makes sense. So therefore, doing share buybacks means you artificially increase your earnings per share. So there's a site which I'll let James have it, but there's a really interesting site, and they claim that actually there's less than 15 companies in the S&P 500 that are net cash positive, and the rest, what they've been doing is leveraging a balance sheet. And, you know, the European Central Bank owns something just under 20%. I was told by someone last week when I was giving evidence for this parliamentary thing we were talking about off the air. They were saying, yeah, European Central Bank got nearly 20% of all European corporate debt. So if corporate debt starts running a problem, the European Central Bank's balance sheet is just going to be obliterated. But I hope that helps.
Wow. Yeah, absolutely. Thank you very much. Yeah, thank you very much.
Jonny, thank you so much for your time and for battling through technical challenges we've had today. That's fascinating. Lots of really interesting input from you. Thank you everyone who stuck with us. We will be distributing the video around. Just to say, Jonny, just to reconfirm, Jonny runs and publishes the weekly update Digital Bytes, which you can get straight from Jonny Fry and Team Blockchain, but you can also get through the Digital Future Fund as a member, or on the, and some of the articles are on the New Future Foundation as well. And that includes real case studies, multi-jurisdictional analysis and analysis of different industries, and is fully verified and covered by regulatory oversight as well. So that's well worth a read. Thank you, Jonny. We have more events planned coming up in November, December, and January. I'll talk about them and send around an update to everybody who intended or tried to attend with those dates. Thank you again, Jonny. It's been really interesting.
You're very welcome.
Cheers, everybody. Thank you very much for joining.